G'day everyone, welcome back to Pete's Investing and Trading channel. Today we are trading the CCI14 strategy with the average down approach compared against the relative strength index 2 period, a breakout, and see which strategy is more efficient to trade. In this video we'll cover the entry, exit, average down rules for each strategy, review charts for each company, table of results for each strategy, and stay tuned until the end of the video to review the trading guidelines and trading rules. Don't forget to review our playlists which cover trading strategies, share price and indices reviews, and this video will be covered in the strategies playlist. And that's in the strategies playlist where we cover the simple trading strategy, the average down process and some money management ideas. We're not offering financial advice, but rather it's an educational series to help you make better trading decisions. Let's get started. I'm about to demonstrate the entry and exit strategy with two scenarios. The first scenario is where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit the trade when the closing price gains at least 5%. Take your profits and wait for another trade using the entry rule. We average down when the close of the day declines by at least 5% and the CCI14 breaks above the zero line. We then buy double the quantity of shares from the previous trade we made. Note, we don't use stop losses. Again, watch until the end of the video to review the trading rules and guidelines. And the second strategy demonstrates an entry when the relative strength index 2 period crossing over the 10 or the 50 line. Exit when the price gains at least 5%. And again, don't be greedy, take your profits and look for another trade using the entry rule. We average down when the share price drops by at least 5% and the relative strength index 2 period crosses over the 10 or the 50 line. Note the relative strength index indicator is standard in most charting software trading platforms. I try to use very basic entry exit techniques so you don't have to develop any complex strategies yourselves. So let's look at some of the charts, and we'll first look at the Commonwealth Bank of Australia. Now what I want to bring to your attention are some basic explanation of this chart. First of all, I want you to focus on the chart pattern. This is a share price with a chart pattern. Note each chart or each company that I'm going to demonstrate has a unique pattern or fingerprint. So there are no guarantees of the same results in future. We're back testing to the beginning of January 2007. This allows us to measure results factoring in the GFC in 2008, 2009, and more recently the COVID period and the Ukraine war. We trade with $2,000 lots per trade. So every time we buy $2,000 worth. So if you want to add more to your funding and trade more, that's fine. Or if you want to trade less, by all means. And I suggest you trade less to test the strategy and make sure you're happy with the results and what you're gaining. Note the profitability of these two strategies. In particular, the drawdown of each. So the drawdown is measured from the highest point of profitability down to the lowest point throughout this period. Note, and that would have been the biggest drawdown for that strategy. There's a bit of a drawdown there, but not as much. That would have been a big drawdown from there down to there on that strategy. This strategy here is the CCI14 profitability, and this one up here is the RSI2 period strategy. I'll explain that in a bit more detail as we go through this. Ultimately, the strategy will always close out each trade profitably so long as we maintain good money management and discipline, hence the table of results I'll show you in a few minutes. And note also the profitability charts have a baseline of 100,000. This allows us to see the effect of the profitability when it falls below the when a drawdown takes effect and it falls below the $100,000. We show the indicators down here below. You can see down here, this is the CCI14 strategy with a zero line, and this is the RSI2 strategy with a 10, 90 and a 50 value. And that's where we enter the trade for those, and I'll explain that in a bit more detail. Lastly, I've chosen to track results of a set of blue chip companies, and I'll go through the table in a minute. And keeping this list consistent does two things. I can't be accused of cherry picking stocks that only do well. Each stock has a unique pattern, so in some price charts they rise consistently, others go sideways, and others might gradually decline over the years, but ultimately we see the profitability of the results of each strategy. Let me first explain the basic strategy for the CCI14, and that's using the CCI. When it breaks above 0, we enter the trade. We exit the trade when the price gains by at least 5%. I've drawn a little ruler here. When a 5% gain is made, as it would have done back there, and just broke above it, so we exit the trade over here. That would have been above our 5% gain, so we exit the trade. That's what those blue bars represent. That's our CCI14 profitability. This one back here, indicated by the brown arrows, indicate where the RSI2 would have broken above the 10. We enter the trade, and we exit again by that brown cross. It's a bit hard to see, but we exit the trade there when it breaks above 0, above the 5% gain. So if I move that profitability ruler, it's gained at least 5% there, hence we exit the trade just above that exit there. So we exit the trade there for that RSI2 profitability. That's entering one lot of shares for each of those strategies. Let's quickly look at another example. Again, I'm looking at the Commonwealth Bank here. Let's blow that up a bit. So let's look at first the CCI strategy over here. And again, if we move the profitability, if we move the 5% minimum drop, it's a 5% drop down to there, that point. You can see there, we enter the first lot of shares there when the CCI14 breaks above 0. Now we don't stop it out. We don't use stop losses. The price goes against us. It's dropped more than 5%, but our CCI14 breaks above 0 again. We enter the trade. That's our second lot of shares entered there. So now we've got, here we started off with 26 shares. We enter another lot of shares there for $2,000 worth. Now we've got a total of 80 shares. Remember, we're not buying a set number of shares. We're buying the number of shares that go into $2,000 of each trade. So we bought $2,000 worth of shares there. Now ultimately we close out that position for the CCI14 when the average price, and the average price would have been somewhere in the middle there, breaks above 5%. And that would have been our exit on those two lots of shares we entered there. That's our profitability made. We enter there, we close it out, profitability there. You can see the profitability at 14,170. We started off profitability at 13,806. So that made a nice little gain. That's a CCI14. The RSI2, you can see here, we entered one lot. You can see there, that entered when the RSI2 broke above 50. We enter another lot when it breaks above the 10, and so on. So we use 10 and 50 because we want to get in and out of trades a bit more frequently with the RSI2. Also with this strategy, with the CCI14 strategy, we double up on our shares. So if we bought 26 shares there, we would have, like I said here, we bought 26 shares there. And here we had a total of 80. So whatever it is, 80 minus 26, we bought double the number of shares we would have bought down here. We bought 53 shares, so we bought double the 26 roughly. Here we buy one lot of shares only. So we ended up buying the first lot of shares there, we bought 22. There we've got a total of 45, 67, so roughly entering about 20 odd shares in each location. So here we see there 22, we bought there another 22, another 22 shares, another 22, and so on. Where ultimately we had up here, we're running around about 90 shares across during that period of those months. But ultimately we closed out. Again, we bought all those shares when the average price broke above 5% gain. That would have been our closeout. So you can see there the closeout profitability was 7,369. We opened up at 70.34. So we made about just under $300 on that trade. So that's explaining very briefly the entry and exit of the multiple average down approach. So that's a CBA. Now what I want you to, I'm going to show you the remaining few shares. I'm not going to go into that much detail. What I want you to focus on is the chart pattern. You can see here the CBA did quite well in terms of going upwards in price. Went a bit of a downturn during those years. Hit COVID, then it started going up again in the last couple of years. So just focus on the chart pattern, and I'll go through the profitability in a table later on. Next, I want to show you Bhp Australia. I'll go through this fairly quickly. Again, I want to demonstrate the chart pattern. You can see here quite a substantial drop. There's a bit of a drawdown in both strategies, and you can see the number of shares held in both strategies. Bit of a nice increase in share price for BHP since 2016. I'll show you Volkswagen Europe. Again, fairly flat across the board. Bit of a share accumulation in those periods. Bit of a rise there. Not much of a drop during COVID, but it's been declining since the start of 21 in terms of share price. But you can see the profitability and I'll go through the profitability in the table coming up. Telefonica, this is probably our most declining share. Again, you can see there going fairly sideways, bit of a roller coaster, but been declining and a bit of a slight upward swing in 2021, but quite a substantial downswing since 2016. But again, profitability, it's broken above our break even. You can see there the profitability along the way. JP Morgan, a couple of US stocks I'll show you now. This has been doing quite nicely. Again, you can see the number of shares held throughout the period. Johnson & Johnson, again, done quite nicely in the last, since 2007. A bit of a downturn there for Johnson & Johnson during COVID, like most other companies. And then lastly, let's look at Caterpillar. And again, fairly flat along the way there. Bit of a rise there, bit of a decline, and then a nice big rise since 2020. Now it's been leveling off since 2021. It's been fairly flat. So let me quickly go now to the, where are we here? I've explained the charts. Let's look at now the table of results. So this is the results for the CCI14, and you can see there we're trading $2,000 lots for each of these, and we'll be beginning back testing from January 2007, which covers the GFC, COVID, and the Ukraine downturns. We show the total revenue per stock, the number of times we had to average down, the total drawdown effect, that would have been that row for each of those there. Now remember, the drawdown would have been during one main period. It wasn't throughout the whole period since 2007 till 2022. So it would have been predominantly during the GFC was the biggest hit on the drawdowns for most of the charts. And then a monthly revenue generated, which is simply looking at over the period, number of months, and that's a monthly revenue of about 461 had you traded those since 2007. That's the CCI14 strategy, which we went through a bit more detail earlier. These are results for the RSI2. And as you can see, the results for the RSI2 period approach with a 5% gain, an exit trade, or a decline of a 5% average down. Again, feel free to pause the video to digest the results. Next, we look at the, this is the summary of the two programs or the two strategies. You can see here, we back tested the total revenue generated was more for the CCI14 strategy, 84,742. So for the years since 2007, about 20,000 more than the RSI2 strategy. But very importantly, notice the drawdown. The maximum drawdown of all stocks combined, and again, this is by all combined, was 228 versus 149 for the CCI14. So profit over drawdown, which is simply that over that, was 57%. That's our key KPI we use, versus 28%. So the higher the profit over drawdown, the better. You can see the monthly revenue was 461 versus 350 for the RSI2 strategy. So in terms of our entry guidelines, we covered a couple of simple trading strategies with a better probability of price increasing from our entry point. There are many videos which show you how to enter a trade, but most of them don't clearly explain how to exit the trade profitably. In this video, we showed you an effective way of exiting the trade profitably. Note also we don't use stop losses as a sure way of minimizing returns and more often than not losing money from your trading account. Instead of stop losses, we use the average down strategy with some disciplined money management. We show you how to effectively average down and ultimately close out the trade profitably. This approach has been backtested on stocks, CFD indices, commodities and forex currencies. Again, the key here is good money management, and especially in trading leverage instruments such as CFDs. And today we backtested, traded and buying stocks outright with your own funds. We show the calculated funds required when following the drawdown approach. We backtested it to 2007 to show the effects of the GFC and more recently COVID and Ukraine conflict downturns. On average, we show the returns that would have been generated had you traded $2,000 per trade. These don't factor in any dividends, so any dividend payouts would have been added as extra bonus funds. Some of my investing rules: buy proven blue chip stocks only, avoid speculative stocks. This ensures the probability of the shares of the company you're buying has had a good track record and more likely to potential future growth. Buy stocks which pay dividends. Do a quick search of the stock before you buy to ensure it recently paid a dividend or is about to. This is a good indicator that the company has future potential of growth. If the company recently stopped paying dividends, it may be a sign of their growth potential may be challenged. Don't short positions, go long only, even though our strategy can be applied in CFDs and other leveraged instruments. In this video, we only trade in shares we bought with our own funds. Avoid borrowing or leveraging funds to minimize risk. Also, if you short an instrument which pays a dividend, you will end up paying that dividend to someone else who went long on the same instrument. Do not trade on news. Price is already factored in the share price. If you read an article in the finance pages which talks about an event on the stock market which you're considering buying, the chances are it has already been factored in the share price, so you've missed that boat. I did a video in September 21 titled Uranium Stocks Too Late to Trade, which demonstrates the effect that news has or hasn't had and the share price action. Suggest you watch that video. Thanks for watching. Don't forget to click the subscribe button, the like button and the notification bell, and see you and happy investing, and see you in the next video.